The Uganda Central Bank has maintained its key lending rate at 9.75%, keeping the benchmark unchanged since October 2024. The Bank of Uganda's decision comes as inflation edged slightly higher to 3.2% year-on-year in January, up from 3.1% in December. The central bank governor stated that the current policy stance remained appropriate to support economic activities while ensuring inflation stabilizes around the bank's target. The Apex Bank aims for core inflation of 5% over the medium term and targets core inflation of 5% over the medium term. The International Monetary Fund and World Bank are on identical growth projections for Nigeria's economy, with both forecasting 4.4% expansion in 2026. Though they differed slightly on the path in 2027, they painted a contrasting picture for the sub-Saharan African region. The IMF World Economic Outlook released projected Nigeria's GDP growth at 4.4% in 2026, before moderating to 4.1% in 2027. This closely mirrors the World Bank's Global Economic Prospects published earlier, which maintained that 4.4% forecast through 2027, suggesting marginally higher confidence in Nigeria's ability to sustain momentum. Both institutions have revised their 2026 projection upwards by 0.2 percentage points from their October 2025 estimates, acknowledging improvements in Nigeria's economic fundamentals. The alignment between the two multilateral lenders provides validation for an ongoing reform efforts, though both cautioned that significant challenges remain. Now, this development also follows a recent commendation from the World Bank with regards to economic policies of President Bola Tinubu. That was after the visit of the World Bank to the villa and, of course, to economic managers of the country. And they talked about Nigeria's economic reforms, commending government. My guest today to start the week is Nabila Mohammed. She's an investment analyst with Chapel Hill, Denham. And Nabila, thank you so much. It's good to start the week with you on Business Nigeria. Thank you for your time.
Good afternoon, Mr. Tolu. Thank you for having me.
All right, then, Nabila, I think we should start with that good comment, I should say, again, coming from the World Bank. And many say, well, this looks like we are getting to that point where Nigeria shifts from that edge of reforms to stability, one way or the other. So let me ask you, what do you make of this comments coming from the World Bank at this very critical time that Nigeria is assessing the fallout of the reforms instituted by President Bola Tinubu?
So to be honest, the comment was expected because if we look at how we started last year with all the upgrades to our credit ratings, with all the reforms that have been put in place, whether in the FX market or in specific sectors like the oil and gas sector, you would agree with me that truly we have seen some level of expansion in economic activity, and that alone has attracted, foreign investors, not just from, the World Bank standpoint, even the IMF standpoint as well, because there was news flow sometime last week that Nigeria ranks among the top 10 countries that would drive global growth in 2026. So this statement or comment by the World Bank representative was not a surprise to me because I believe that there are some things that have already led up to that. And if we look at the reforms and how they are reaping, we're currently somewhat reaping the benefits of those reforms currently, you will see that it was just a matter of time for them to start to say things that are positive around Nigeria. And it's not even the World Bank alone. We've had news flows around the intention to add back Nigeria to some indices that previously used to track some of our asset classes, like bonds, like equities, and these are just positive news flows, and it's because they truly recognize the impact of the reforms that have played out, particularly in the FX market. Because as investors, what they really look out for is, some level of stability. Fine, there should be some level of appreciation, which is what we are seeing in the currency currently, but stability is more sustainable in the long term, and that is what they are seeing. And that is what even the credit rating agencies, as Moody's, S&P, as well as Fitch, mentioned when they upgraded Nigeria's credit rating. And it's also reflected in how successful our Eurobond issuances were back to back in 2024, as well as the one that was done in 2025. So we've really seen improvement on that front. So the comments truly did not come as a surprise to me because of some of these things that I have mentioned.
Great stuff. Now, many will say we've seen key monetary and foreign exchange reforms. We've seen inflation easing, exchange rate stability, and of course, all of that, external reserves strengthening. But the question would be translating this into sustainable economic growth. That has been the challenge, and that is what some are worried about. What do you make of that, and what do you think government should explore at this time to achieve this?
So I think they are beginning to somewhat explore other options. Last week they brought out the gas master plan, which seeks to tap into our gas reserves that currently stands at 209 trillion standard cubic feet, and that simply means that we have so much of that we can leverage on in terms of meeting up with exports or trying to meet up with global demand for gas or natural gas. So that is one step in the right direction. If other subsequent reforms come up across other sectors, then we should see some level of positive impact. We like what the Dangote refinery has really done, and I believe that is sustainable. It has come to stay. The concept of import substitution has come to play because we are now refining our crude oil locally, and that is satisfying, the Nigerian market before we even think about exporting the rest. So that is a positive addition to something that I believe can be sustainable over time, because Dangote refinery, of course, is here to stay. If they're able to, bring up the other refineries and make them to be operational and functional, then that would also add to the capacity that Nigeria has as a whole, and that again speaks to being sustainable. There are other things that may not necessarily look sustainable in the long term right now, and that is, the level of inflows that we're seeing in the FX market. FPIs, we always call them hot money. They chase after high interest rates. So what then can Nigeria do? In my view, I believe that Nigeria should, just like they're doing, look to diversify our export earnings more. The whole gas story is something positive. If they can leverage on that, that would be good enough. And there are other sectors that we can focus on that can really, bring us out of the wood when it comes to earning FX. Look at the manufacturing space. Look at the industry as a whole. That space really needs some level of transformation, infrastructural, development that goes on there. We understand that sector, has issues around interest rates, and interest rates are currently high. If we want to see some level of sustainability in terms of growth, that sector needs to do more, because it still accounts for
It's not network.
sustained in the entire economy throughout that period. In fact, with January 2026 print of above 55 points is 11% stronger than what January 2025 printed at, which is 50 points. And it's cut across all the key sectors. We want to see that continue. We want to see that sustained. But we have to see things around FX stability. We have to see things around, security being, managed and changed. We have to see things around, the whole revamp in terms of what we expect across these sectors. And these are some of the things that even FDI, if they want to come into a country, that's foreign direct investment in this case, which is what long-term capital is all about. They would look at all these things. They'll look at your energy, they'll look at security, they'll look at your infrastructure, they'll look at your policies, they'll look at a number of things that will give them that peace of mind that this place that I'm coming to directly invest in has all the parameters in line. And yes, we have started to see that Nigeria's reforms, have started to play out, have started to encourage those flows. But The moment interest rates start to come down, even if they come down, I will still see that there is opportunity for the FDIs to remain here because we're expecting that the US Fed, with the new appointment of the new governor that would resume sometime in May, once he comes, he will definitely want to do what is expected of him, which is go dovish. And that would mean that these foreign investors will direct their funds to markets that, they still have some level of carry trade opportunity. And Nigeria is still one of them because in-house, we do not even expect a rate cut in this month. We expect a rate cut sometime in May, which will be the next meeting after February, which is this month. But we may see, some adjustments in corridor. But just speaking to interest rates alone, they will still be attracted by that level of carry trade, and that will make them to remain here. Because if I would give you some numbers, January alone saw average FX daily value at $358 million. Average daily traded $358 million. And that figure is very close to the $394 million on average for the entire 2025. It means that these people are actually coming in. And that is even largely the reason why the 5.1% year-to-date appreciation in the currency is what we're seeing. But then, like you rightly said, sustainability does not revolve around in and out funds. It revolves around structural reform, and that is what we believe that they are trying to do in the time that they have given, they're using this particular time where FPIs are very high and at their peak to, put in place those policies, put in place those structures that would help us to see the sustainability beyond the short term that we're looking at.
Interesting, so, but I'm going to take it up from the MPC meeting, which you mentioned, which should happen sometime next week. So you're not thinking that we could see that shift with regards to MPR at this time, or you just think maybe parameters surrounding the MPR is what might see a shift? Because the guys in the manufacturing space, of course, those that want to borrow, they are groaning at this time and they're not so happy. What do you make of that? So you think we'll still remain with a 27% MPR?
To be honest, there are some things that will be considered as that meeting. I understand the plight of the manufacturers because of high interest rates, and truly, even if we see rates in the fixed income market come down, it will still center around the MPR that these banks will lend to these businesses. And given that it is not down yet, it will still be difficult. Interest rates will still be a concern, even though they are winning on the FX front because most of them are no longer booking FX losses. But why do we think that they would not adjust this in February? If they adjust it, to be a positive surprise, but in our view in-house, we do not see them adjusting it this month. And here is why. When inflation print for January comes out, our expectation is that it will print between 18 to 19%. And that 18 to 19% is above the 15.15% that was printed in December 2025. If the Monetary Policy Authorities did not cut interest rates at the last meeting when inflation was even much lower than this 18.9 to 19% expectation, will they now cut or be emboldened to cut when it now prints at 18 to 19%? I think that's the question that we need to answer. And if they now, decide to, still be bent on cutting it, then they will definitely see a cut. But our view is that if that print comes out higher than 15.15%, cutting it would be, how do you now explain that you're cutting interest rates when inflation, went higher year on year to 18% versus 15.15%? Fine, what we expect is that there may be some adjustments to the asymmetric corridor because we started to see signs given where the last automobiles auction rate closed at, which is 17.25, versus what it previously used to be around 19%, translating to an effective yield of above 22%. If we see that happen, that's something that the market has already told us will likely happen, given where automobile rates at the auctions closed at. But for the MPR itself, our view is that conservatively, before they decide to cut, they would have to see some level of disinflation being sustained. And January print expected is not going to come out below 15.15%. Because if it were to do so, it will mean that on a month-on-month basis, not year on year now, on a month-on-month basis, we should see headline inflation coming at minus the figure. So if that is the case, then we'll definitely see a lower year-on-year print for January 2026. But these are our own views in-house, and that's what we expect the monetary policy authorities to do in their meeting on the 23rd and 24th of this month.
Getting more interesting. Well, again, analysts say for businesses, for companies, there's a bit of predictability, the operating environment, planning, investment, and growth decisions. Let's talk about investments, which I know is your forte. We've seen the recent one with Nigeria and Turkey. The president was there again, 9 agreements signed and all of that. And it keeps coming, and we expect more to come in. In 2026, what are your thoughts with regards to Nigeria's investment drive, and what are your expectations? For me, I think we should start talking more of FDIs now than FPIs.
I agree with you totally, Mr. Tony. We should start talking more of FDIs. And, you know, I like to refer to the president as the chief marketing officer of this country. So he's doing a good job putting Nigeria out there, and we're seeing it. We're seeing the result of it with regards to all the comments, all the, talks that the World Bank, the IMF are all putting out there in favor of what reforms that we have done. So it just simply means that we're getting something right. And it really just boils down to sustainability. So for investors to really look at, the landscape, the entire economic landscape that Nigeria currently has, they would look at a lot of things, a number of things. FDIs have more long-term views with regards to their investments. So they will not be looking at, things that will likely point to instability in the future. And even if they were to come in, you know that this year is also a pre-election year. Next year is now the election year. So these are things that they would watch out for and see how it will play out for the rest of the year before they now decide to, take positions in this country. But that's not to say that we do not already have these FDIs in here that even believe firmly in the market. We have the likes of PZ, we have the likes of Nigerian breweries that are still here, we have the likes of Nestle that are still very firm believers of the market or of the economic landscape, and they remain here through thick and thin, I would say. And that just simply speaks to the fact that in as much as there are FDIs that are likely to be new flows into Nigeria, we still have the ones that contribute to our FDI stock that, regardless of whatever is going on, they are still here because they understand the importance or the value of that Nigeria brings to the entire African landscape, whether in terms of youthful population, whether in terms of, the market, the demand for their products. These are some of the things that they look at that makes them to still remain in this market. And we may likely see more coming because in as much as we're seeing appreciation in the currency, there's some level of predictability, like you rightly put. And these are some of the things that investors, whether long-term or short-term, look for. They look for things that they can easily predict. They look for things that are stable with regards to their investment. And that's what we encourage them to come here. So in as much as all these things that I have said are, things that different kinds of investors look at, the optics really look favorable to them, and we will likely see more improvement in terms of flows, in terms of foreign direct flows, much later if this level of reforms or stabilization that we see across the economy is sustained.
So are there concerns with regards to the coming election? That is also something that analysts have identified, saying that could be, probably, I don't think that should disrupt economic activities, but some analysts are saying this could have an effect on projections.
We did some analysis in-house and we looked back to as far back as 2002, just singling out all the pre-election years over that period. That's from 2002 to date. And what we noticed is that in the past 5 pre-election years, only 2006 did not see a depreciation in the currency. So in as much as we are seeing an appreciation in the currency right now, if there is, any form of pre-election activities that will result in higher dollar demand because investors want to repatriate some level of funds, we may likely see some depreciation happen. And we are not expecting that it will be as high as what it has averaged over this period, which is 5-7%. In fact, in-house, we're expecting around 4% depreciation in the currency, should in case what what happens normally in a pre-election year would happen again this year. So it depends on how the government really handles it, and that is a risk. Because fine, we are seeing this appreciation within the first, 5-6 weeks of this year. But how sustainable will it be if the election activities do not, play out? But then we recognize the upside, which is what I earlier mentioned: the flows that have improved, our reserves that are current peak, a lot of positive comments, and these foreign investors that are bringing these flows, they are listening to these external parties, such as the World Bank, the IMF. They are listening to what they're saying, and they are taking positions. So these are some of the things that will not necessarily allow us to have a depreciation that is maybe above 5% this year, in case there is any. In-house, we'll be happy if the currency remains, at current levels, which is 1300, 1366 as it last closed at. But fine, these are risks. So if they are not able to manage whatever pre-election activities that is going to happen, particularly in the second half of this year, then it would have a ripple effect on, how we are viewed as a country, and if we are truly going to be sustaining the reforms that we have put in place over the past 2 years.
So it looks like it's pretty good all the same at the end of the day, right? Is that what you're saying?
Yeah.
Considering all forms. Well, let's leave it at that. One more question that came into my mind before I let you go. Just earlier today, President Tinubu reeled out a speech at the NEC conference where you have governors and everyone coming together. And the roles of the subnationals was re-emphasized at that gathering. I'd just like you to comment about what you think about the synergy between the federal government, states, and local governments, particularly at this time where revenue seems to be very much on the high side.
So indeed, we should see that synergy across the levels of government, because if we do not have that, it will mean that either one of the subnationals is operating in isolation of what the entire plan is. The entire economy is planning to move to $1 trillion economy. So he needs to make sure that everyone is on board that goal. And for everyone to be on board that goal, whatever they have to do within their own jurisdiction, they have to get it done. So him addressing the governors with regards to his plans, with regards to the economy as a whole, with regards to their strategies or the strategies that they deploy in their respective areas of jurisdiction, is something laudable, because it's important that you have every governor that is heading in our own state on board your plan for the entire country. No one is expected to operate in isolation, but whatever everyone can do in their respective areas is something that will tailor towards the entire goal, which is achieving a stronger economy at the end of the day. So addressing them is something that is important, and if they have further concerns, they will definitely have brought it up during that time. So it's something that I believe should be encouraged, just meeting up with the governors and trying to understand where they stand in their own respective jurisdictions.
As always, interesting chart with you. I've been speaking to Nabila Mohammed. She's an investment analyst with Chapel Hill Denham. Thank you so much for starting the week with us on Business Nigeria. We really do appreciate this.
Thank you for having me.